In this video, we're going to talk about why Nike, the global sportswear giant, has seen the share price plummet by a whopping 60% and whether it is a bargain opportunity or a value trap right now. Watch until the end of the video where I will attempt to do an intrinsic value calculation for Nike as well. With that, let's go. First, we need to understand why Nike's share price has fallen so much. Because it is still a famous sportswear brand, right, that everyone is familiar with. So first thing first, right? The problem with Nike in the past 1 to 2 years is due to two main reasons, right? The first one is that the CEO wanted to focus more on their own website and go direct to consumers, so DTC, and it has went too far because they sort of cut away the wholesale retailers like Macy's, like Foot Locker, and all that kind of wholesalers, right? And in result of that, these retail partners went to look for competing brands like On Holdings, like Hoka, to fill up the gap. And with that in mind, right, you are losing the brand mind share of all these consumers when they walk into all these retail outlets. They are not seeing Nike shoes over there. So if you replicate this whole issue through the entire world, right, you see that Nike's branding fall off a notch, right, due to this approach. And the Nike CEO also acknowledged that they have went too far, right, when they sort of cut away the middleman stores lah, in favor of their own branding. They thought that they can go directly to consumers. Okay, so that is the very first mistake. The second mistake, which is also as a result of that, is that there's no innovation. There's no innovative products coming out of Nike. When you look at the competing brands, right, like On Holdings, you have the those kind of cushion shoes, and Deckers have a very nice design and things like that. So all these rival brands are gaining ground, gaining market share in the expense of Nike. All right, so with that, right, with all these competition, stiff competition going on, and lack of innovation, it is no surprise that their share price has fallen by so much because the long-term prospects wise is not good. But that being said, right, the reason why I'm doing this video is because the CEO has acknowledged his mistakes right now, and they are bringing back a veteran, okay, a 30-year-old veteran, to man relationships with all these middleman retailers. And on top of that, right, if you check out their recent YouTube video, okay, winning isn't for everyone, it is very clear. It's a very clear sign that they are putting back the focus on branding again. Okay, they are going big on the Paris Olympics. Okay, especially when they are standing on top of all these uh, famous athletes, standing on the shoulders of athletic giants. Okay, like Kobe Bryant, LeBron James, Serena Williams, and all that. So if you go check out their website, winning isn't for everyone. It is only for those who aspire to win. And that's how they want to kick up a notch for their branding itself. Okay, so you can just move around and can see all the athletes that Nike has sponsored. All right. And on top of that, right, if you look at the chart over here, okay, so this survey is done in 2022. Okay, so far, Nike is still the worst, most popular sneaker brands. All right, 18% as compared to Adidas 9%, Skechers 7%, and all that. And now let's shift our focus back to the valuations. All right, so if you look at the valuations portion, okay, so Nike right now, if you compare it to the peers, okay, based on simply Wall Street, Nike is sitting at around 18 to 19 times price to earnings as compared to Skechers. Okay, Skechers is more towards the athletic leisure, which is 16 times, so not so far apart. Although Nike is 10 times more the sales of Skechers. Right, so we have the very closely related rival brands Deckers Outdoor, which have Hoka, okay, and On Holdings. So both of them are trading at much more pricey valuations in terms of price to earnings. And on top of that, you have Adidas. Adidas is crazy, 488 times price to earnings. Okay, so while it is not very sexy, if you look at 19 times price to earnings for Nike, if you were to look at their overall price to earnings history in the past 5 years, okay, so this 1 year and this 5 years, you would have seen that it is typically trading at around 30, 33 times, 30 to 33, 35 times, okay, or even going up to 40 times. So right now, like 18 times price to earnings for Nike is like a very rock bottom valuation for them. Okay, so now let's shift our focus to the discounted cash flow model that I want to share with you to calculate their intrinsic value. Quick pause. I want to share this platform called Simply Wall Street with you because I feel that this is a very powerful investing tool I have been personally using and it can really help you as well. Okay, so now let me scroll down to the stock reports, and you can see here that there are various metrics that can really help you to save a lot of time when doing stock research. For example, you can look at the past profitability or revenue trends over the years. Okay, see how the revenue after they deduct the expenses and things like that, then what are the earnings. Okay, next up, you have the valuation and comparison. You can estimate what is their valuation from the platform itself. So what is the fair value, as well as you can compare it to their peers, okay, in relative to their peers, based on price to earnings, price to book, and things like that. Dividend quality. Okay, so if you are into dividends, you would be able to see the dividend trends. Okay, so whether the dividends per share has been going up, the yield is it stable or growing, and things like that. In addition, you can check out their management team profile, right? See whether the CEO, how many years has they been in the company, what is their compensation, their salary, as well as their ownership stake in the company. On top of all these insider transactions, whether they are buying aggressively, okay, either into the company or selling out when things are bad, right? So on top of that, right, if you go to their platform, you can actually check out a lot of stock ideas based on their Discover tab. Okay, so over here you get like high growth tech and AI stocks, undervalued small caps, dividend powerhouses, oil stocks, renewable energy, and more. And now talking about the pricing portion, I would highly recommend you checking out the premium plan. All right, this gives you enough company reports, portfolios, and stock screeners to work on. And if you want, you can check out my affiliate link here down below in the description box as well to get a 14 days free trial and at the same time support my YouTube channel as well. Welcome to the DCF calculator where I will use it to calculate the intrinsic value of Nike. Okay, so what I will do is just to input the name, the stock name over here. Okay, and next I will input the free cash flow, shares outstanding, and then it's auto calculated to give me a $4 free cash flow per share. Okay, so I've already put in the numbers beforehand, and with this, okay, this one will populate it over here. Okay, and then so what we will do is two stage. Okay, stage number one, we calculate it based on the 10 years, the first 10 years after 2023. Okay, so this is the actual number that we have. So A is the actual figure, and then we're gonna estimate, okay, going forward, okay, 2024 to 2033, so 10 years from now, what will be the free cash flow like, okay, based on the growth rate. And then we're gonna discount it back, okay, using a certain discount rate and get all these present value of the free cash flow. Okay, so this is the stage number one. Stage number two is the perpetual growth after the 10 years. So after 2033, so assuming it's still growing, right? But maybe on a slower growth kind of a thing, closer to inflation, okay? So based on that, calculated present value is 75. So we got a intrinsic value, stage 1 plus 2 of $110. So if you compare it right now to the share price of Nike, which is $71, I think we have a good margin of safety of $30. So which is quite substantial, right? So if you take this divide by 71, so it's like a 55%, okay, margin of safety. And if you want to, let's say, if I play around with the figures, okay, assuming that you think that, okay, maybe Nike isn't growing at 5% for the next 10 years, okay, based on stiff competition, maybe the management still not doing their job well and that kind of thing. So maybe you put a 0%. Okay, what happens is that your intrinsic value will drop to $73. Okay, so very, very close to right now what we are seeing based on Nike share price of $71. Okay, so that is assuming Nike will not grow at all for 10 years, and after which is growing at 2%. So I think it is very unlikely. Okay, in fact, given the past 5 years growth rate of their free cash flow, so we are talking about free cash flow, is around 10, if I'm not wrong, it's around 40 something percent, okay, on an annual basis. But that's a bit skewed because you have COVID and things like that. Even if we were to plug a 10% growth rate, the number will jump to $165. So it's almost two times from the current share price of $71. Two times and more. Okay, so let's say we just take a very, very conservative assumption, 5% for the next 10 years, and after which they don't grow anymore. So 0% growth after the 10 years. We are still getting an intrinsic value of $90, which is, more than what they are trading at right now. Okay, so given that uh, 10 years of 5% growth and 0% thereafter, we are at a 8% discount rate. Okay, so this is as of the required rate of return, or rather, I just park, the historical rate from the market index itself, like for example S&P 500. So over the course of 30 years, they are able to hit 6 to 8%. So I just plug in 8% over here. So we are still sitting at the $90 based on all these assumptions. All right. So if you want this Excel calculator, do comment down below in the video, and then I will try my best to see how I can send this link over to you. To wrap up, do you think Nike stock is attractive right now, or do you think that they are lost cause in the long term? Let me know in the comments down below. With that, if you enjoyed this video, don't forget to like, share and subscribe, as I will be posting 2 videos every week. Thanks for watching and invest safely. Bye.